Yes, huge update from the Fed, a trend change. The Fed just gave everybody 300 billion more reasons to buy Bitcoin. Printer just started. Brrr. Also, the Fed just released the cryptocurrency bulls. Of course, like always, what I'm referring to is the Fed total assets on their balance sheet is again flipped, going back up. And to put this into perspective, zooming out, we know that when the Fed puts assets onto its balance sheet, meaning they buy assets, that's one of their ways for quantitative easing. They're trying to stimulate the market. We saw that after the 2008 housing crisis. We saw that drastically after the 2020 pandemic crash. And now this week, since all these banking collapses, we're seeing it again. So I'll play you a clip of what experts say about this in a second. But let's just talk about the facts. Because while crypto Twitter thinks that the Fed's $297 billion balance sheet expansion is QE, some say it's not. What? So here are the specifics. The US Federal Reserve's balance sheet has expanded by almost $300 billion to now $8.63 trillion in the week of March 15th, reaching its highest value since November. And by a standard definition, this should be considered a pivot back to quantitative easing. Quantitative easing, or QE, which involves buying assets such as government bonds and mortgage-backed securities to inject liquidity into the financial system, is the basic definition. And just zooming out, QE has always historically been very good for Bitcoin. QE, initiated after the 2008 crash and following the March 2020 pandemic-induced crash, expanded the Fed's balance sheet by trillions and stimulated asset prices, including cryptocurrencies. So why isn't this week the same? Well, the recent balance sheet expansion stemmed mainly from banks borrowing short-term loans from the central bank to cope with the crisis of confidence triggered by the collapse of the 3 US banks. Meaning technically this isn't free money, it's just a loan, a short-term 1-year loan. And as stated by analyst Mark Chandler, QE is increasing the balance sheet for monetary purposes. This is about financial stability, and all expansion of the balance sheet is not QE. So the main problem from these banks is they had the assets, but they didn't have the liquidity because a lot of their money from their depositors were in more longer-term treasury bills. Now, many of those treasury bills would mature in about 10 years. The issue is there was a little bit of a bank run, and depositors and the banks needed that money now. So what the Fed said is that, hey, you can give us those long-term assets, and we'll give you that short-term liquidity. It's a loan, it's due in a year, but then you have cash today.
And the Fed didn't announce that there was a beginning and an end to this program other than saying these would be 1-year loans. And so I think the exposure for the American banking system at a minimum is going to be this $2 trillion, because now the incentive, if you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries.
So Chamath is explaining something very key here. This was on a recent episode of the All In podcast. I'll play you just about a 90-second clip. But listen to Chamath explain 2 things. Number 1, this isn't going to stop bankers from banking, meaning he thinks they're just going to take this money and then buy shorter-term loans, try and get more yield. So it's not going to fix their irresponsibility. And 2, this is essentially just kicking the can 1 more year down the road.
Because now the incentive, if you're a banker right now running one of these banks that has not gone under, is to immediately go to the Fed, put all of those assets to them, get a loan, and now take that and buy different assets, different bonds, different US treasuries that are yielding much more than what your old treasuries were yielding. And I think that's the arbitrage that we've unfortunately created. And the other question now, though, however, is what does that mean for the top 4 banks, right? Because if it's $2 trillion for everybody else but the top 4, what's the gap for the top 4? That looks like it's somewhere between $1 trillion and $2 trillion. So that's another amount of money we're going to have to, or the Fed will have to backstop. And then, as Friedberg said, these checks always come due. What do we do in a year? Because in a year, the problem is The only way to make the banks in a position to repay this much money in 1 year is to cut interest rates so massively that these assets massively inflate, and now all of a sudden you're in a position to cover this.
But these are with the government.
You get a loan collateralized by these assets. So you're still holding them, right?
Yes, and they mature.
So if the Fed takes an emergency posture and says, okay, guys, we want to avert a crisis in a year from now, and we're going to cut rates, these assets that these banks own will be worth more, which will allow them to repay the loan. As far as I can tell, all we've done is we've kicked the can down the road for a year. But I do think it's important for people to realize this doesn't solve the problem. It just means that mark your calendar for a year from now. We have a problem on March 15th, 2024.
So while I would say what just happened isn't full-blown quantitative easing, this is a major baby step showing that the dam is starting to crack. And again, when in doubt, zoom out. Last election year, the Fed's assets, total assets, doubled from 4 trillion to 8 trillion. In the 2008 election year, it also doubled. Wonder if this election year in 2024 will be the same. Also, here is the official breakdown of how much money came in each specific loan. I'm not going to bore you with those details. Just know, all things considered, the net assets on the Fed's balance sheet increased by about $300 billion, undoing months of the central bank's efforts to shrink its balance sheet, but that's not necessarily stimulative like QE. The minute we get more information like this, I will make a video. I will always keep you updated. Also, new promo code just for the next 25 people. Use promo code Altcoin Daily Friends and get 25% off your ticket. Come watch us speak, come hang with us, have a drink with us, and just for the next 25 people, details down below. And then finally, just to give you all the information, like always, I showed you a pic of this before, but specifically, this is wild. This is the balance sheet problem that was at Silicon Bank. And specifically, this small green line was all the cash they actually had on hand. This is what they should have had if everything was back to just 1-to-1, but obviously all banks loan out your money. So while this little snippet was the cash, right here, almost double that was available for sale investments, so they could have got this ready if they needed it. But the rest, probably 75%-ish, were held to maturity investments and then net loans. So in summation, phase 1, dodgy investments began to lose money, the market started paying attention. And then 2, customers panicked and rushed to withdraw, resulting in a liquidity crunch. And actually, they do say when you deposit your money in the bank, it becomes their liability, not their assets. So I'm not sure actually which cash represented the customer's cash, the bank people banking with them cash. But obviously, so many more investments in non-liquid loans. Like always, see you tomorrow.